So if you've been following the market recently, you'd have probably heard of Opendoor technology stock. It's probably been the most popular stock on the market for the last couple of months. It rose all the way from 50 cents around 2 months ago to recently hitting $10, or north of $10. But I wanted to come on here today and talk about why I am definitely not buying into Opendoor stock or any stock kind of similar to it in the market that are much more prevalent and bigger in market cap. Opendoor stock definitely is, I think, an intriguing business model. They buy and sell residential real estate is the description on the company. And I think that model is pretty solid. I'm not sure how much growth it really has in the future. It's not like a big AI company or tech company that really has room to flourish in the future. And their financials, their revenues are pretty solid. They haven't really grown in the last couple of years, but they're yet to make money. They're losing less money each year since last year, but they're still losing money. So obviously it is a very overvalued stock. I think after this original run up, when it was probably around 50 cents, it was very undervalued. And then this original run up to $3 was maybe a little warranted. And then it kind of dropped down. And then recently it has seen an exceptional amount of growth all the way from around the $3 original run up to now hitting $10. And this is definitely intriguing as someone who maybe is a little newer to the market, but as I've gained experience and I've been investing for over 2 years now, I've learned that these stories kind of replay themselves. I was personally invested in GRRR before its run up, and I watched it hit $4. And it originally ran up all the way to around $24 and then dropped back down. That's kind of similar to the Opendoor original run up to $3 and then dropped down, and then it really took off and it hit all the way up to $40. And that is when I knew, it obviously isn't going to sustain this growth. I took a little bit of profits. I didn't sell the whole position because I still really loved the business model and the company, but I knew that this was just at this point just become hype. And it eventually ended up dropping down all the way to $16. And since then it's been, kind of stable. And I especially now, believe in it and think that it has a lot more room to run. And I personally do own a good chunk of GRRR. But Opendoor stock is pretty much the same thing. I see it dropping back down to around $3. And that's just an easy decision for me to make, to not buy into it at these levels. Maybe when it's at $2 or $3, I would maybe consider buying a little bit. But even then, I don't think I'm going to really be buying anytime soon until it has a more established financial path and just financials in general. So this is kind of an easy decision for me to make, but there's a couple harder decisions that I kind of have just chosen to just tell myself that I am never going to be investing in these certain companies. The first is Tesla. I made a video on it back in January when it was around $400 as to why I wouldn't be buying it yet. I didn't 100% rule out just the idea of buying it. And after that, it crashed pretty hard down to around 230 at the low. And, it's not that difficult to predict those crashes just because the price to earnings ratio was around 300 at the time. It was really not doing that well. You look at their financials, they have kind of underperformed massively over the last couple of years, honestly. And that kind of warranted the crash. And the thing is with those crashes, and that's why I will never really invest in these types of companies that are extremely overvalued. I mean, the price earnings are up to above 200, 300, 400, 500. It just gets to be a point where they can crash on any given day and no one would really blink an eye. They'd say, oh, that's why it crashed. A stock like Uber, which is one that I cover and I've loved and I've owned before, that can't happen because the price earnings is around 15. So it can't just crash and people would then be like, oh, what's going on? Tesla, it could crash down to $100 and people wouldn't, the price earnings would still be, still a relatively high. So I thought maybe it would crash a little more if it was crashed down to 150. I'd consider buying, but right when it was continuing to crash, it now is back up to 400. And obviously, if you bought at the low, you would have made a good chunk of money. But at that point, that's not investing. That's just speculating. All my positions, I hope to hold in the short term and the long term. I'm not just going to be flipping them and swing trading with them. That I think is where you lose a good amount of money. So Tesla is one that I think I'm definitely staying away from. I think that if you're a shorter term investor, maybe you go after it. But if you're a longer term investor, definitely stay away from it, because you could easily lose 50% and no one would even blink an eye or have any explanation for you as to why. And Palantir is another one that recently has been very popular. But the price to earnings ratio is around 570, which is just unheard of. Yes, their growth potential is crazy. Yes, they have government contracts that are going to be signed and that already have been signed. Their financials are very solid, $1 billion in quarterly revenue. They're making money. Their profit margins are solid, but the price to earnings has gone so high that if they even slightly miss an earnings, or if they even slightly slow down growing wise, this thing will be back to $100. And you kind of saw this pullback originally down to 75, which is the same thing as Tesla. If you bought Palantir 110, it dropped to 75. No one even blinked an eye. Now it's above 170. This thing could drop back down to 110 and no one would blink an eye. So definitely I am staying away from these stocks at least until they drop down. I don't think Palantir will ever drop down to a level where I think it'd be acceptable to buy. I think under an 100 price earnings would even be a little still too much, but that would make it a little more acceptable for me. But once again, 500 price earnings ratio is really what I look at on, am I going to buy this stock? That's really the first thing I look at. If it's above 70, at maximum, I'm probably not going to buy the stock unless I think it's still a little undervalued for the growth it offers. Palantir, every bit of growth has been priced in, and it's gotten to the point, same as Tesla, where it's just become plain overvalued. So I think Opendoor stock can be used as a lesson as to these really, really overvalued stocks that I think certain people will buy into and might have short-term success. But I think as a long-term investor, I just really want to just be patient and not fall into the temptations. And I think you guys should also kind of just realize that and learn that, is that, there's going to be other stocks like Opendoor that are going to come up and that they might seem tempting because you're holding your investments and they're up only 5%, while these investments are up 10 times. So 1,000%. That is not going to be sustainable in the long term. You read any investment book, The Intelligent Investor, any other one, it's going to tell you that, is that those, meme stocks really, and that's really what Palantir and Tesla and Opendoor have really become. They don't sustain themselves, and they might be good for a year or 5 years, but over a span of 30, 40, 50 years, they are not going to sustain themselves. And I think that's kind of the biggest lesson you learn from Opendoor stock, and that's why I'm not going to be buying Palantir, Tesla, Opendoor, any stock really like that in the near future or long-term future. So let me know what you think in the comments about buying stocks like that. If you enjoyed watching the video, subscribe and see you next week.